All right, welcome back. This is part 3 of the Chapter 1 introduction. So we've learned the cost principle. Remember, that is that accounting information is based on actual cost, not what something is worth or intrinsic value, but just what it actually cost us. The next important principle we're going to learn is the revenue recognition principle. This is one of the most fundamental things that will guide both financial accounting, and if you're going to be in managerial accounting next semester or sometime in the future, this is one of the most important principles that will guide just about every decision we deal with. That and the next one we're going to learn. And the revenue recognition principle basically states when a company must recognize revenue. By the way, the term recognize is used in accounting. It's really just a fancy term for when a company has actually had revenue or needs to record, meaning write down in the books that we had revenue. And the rule is quite simple. A company must recognize revenue when it is earned. Now, really important, most of us in the real world tend to think of revenue as when we get cash or when we get money or when we receive some sort of goods. And in accounting, that has absolutely nothing to do with when revenue is earned. Revenue is earned whenever the company does whatever it is in the business of doing. So, we do not need to receive cash, we just need to have done our job or completely fulfilled our end of the duty in order to receive or to have earned revenue. In other words, if I provide services to a client of mine, I've completed the services, he now owes me money, I have earned revenue. He may not have paid me cash yet, but I have earned the revenue. Similarly, if he pays me money in advance, but I have not done the job yet, I haven't earned that money, I now have an asset, but I owe him some services. So I have not gotten revenue until I have done everything in the earning process. Real important. Think about, have we earned it yet before you recognize revenue? Let's do a couple quick examples. Sticking with our lemonade example from before, our company is in the business of making and selling lemonade. So, it's May 1st. There's a baseball team at the park where we sell lemonade, and the baseball team pays us $100 to supply the team with 100 lemonades on its next game day, which is on May 15th. That's 2 weeks away, but they've paid us the cash today. So, it's May 1st when we receive this cash. Do we record this $100 as revenue? No, that is the correct answer. We don't care about cash received. We care about, have we earned that cash yet? And have we earned it yet? No, we haven't. All we've done is taken their money. On May 15th, we're going to have to squeeze those lemons, put some sugar in there, mix it up with some water, put it on ice, put it in a glass, and hand it to the team. Then we will have earned the revenue at that point. But right now, we have not. All we have done is received an asset of cash for $100, and we now actually owe. We have a liability to that baseball team, to our customer, of $100 worth of service and products that we need to give them on May 15th. So we've got an asset and a liability, but no revenue on this particular one. And again, we know that because of the revenue recognition principle, which tells us, when do we recognize revenue? When it's earned, and only when it's earned. Another example, same company. It's May 1st again, and we supply the team with 100 lemonades, but they don't pay us yet. They say, hey, we don't have the money today, but thanks for that delicious lemonade. We'll pay you $100 on May 15th. On May 1st, do we record this as revenue? Yes. Yes, we do. Absolutely correct. And we record it because we have earned it, right? They haven't paid us the cash, but cash has nothing to do with revenue recognition. Remember, we recognize the revenue once we've earned it. Technically, if they don't pay us, we can sue them for that money. They owe us $100 legally, and we have earned it legally. So we must record in our books $100 worth of revenue. And in this example, we would have revenue of $100 and what's the other side of the equation? Of course, We've got ourselves an asset. It's not cash, but we have ourselves what we learned before, an account receivable, meaning that baseball team owes us $100, which is a legal asset. We own the legal rights to collect $100 in the future. Which brings us to the expense recognition principle, and it's also known as the matching principle. This is probably the toughest principle to understand up front and to apply. This is probably the toughest part of this entire semester, so please dive into this as much as possible. Feel free to send me any questions you have. Send me a text, send me a message, and we can set up the time to speak about it. But this will pervade just about everything we do, at least over the next 4 chapters, and probably the entire semester. It's a mouthful, so let's get to it. The expense recognition principle basically says that we record the expenditures of assets. What I mean by that is when we use up the value of an asset, we record an expense in the same period as the revenues that those expenditures helped generate. I know it's a lot, but what I want you to think about is not just when we exchange assets, but specifically when we use up the value of an asset. That's when we have an expense that we need to write down or record or recognize. So for example, when our company spends cash, doesn't necessarily mean we've had an expense. What I want you to do is ask, what did we get in exchange? What did our company get in exchange for spending that cash? In other words, did we get another asset? If so, it's not an expense. So for example, if our company goes and spends $100 but gets a diamond ring, which it can sell in the future, have we gotten an expense there? No. What we've done is exchange one asset, cash, for another asset, a diamond ring. Only when we use up the value would we have it as an expense. So let me give you another example. Let's say we spend $100 and it was for last month's rent. Do we own something now that will give us value in the future? Or have we used up the value of that $100? Well, the answer is we used up the $100 on our rent. We used it up last month. And more importantly, what I want you to think about, the reason this is called the matching principle, that $100 that we used to pay last month's rent also helped us generate whatever revenues we generated last month, because we couldn't run our business if we weren't renting the facilities that we use for our business in theory. So we have matched the expense of $100 rent from last month with the revenues that it helped us generate last month. We want to record the expenses in the same period as the revenues that the expenditure helped us generate. 2 things to think about. You want to match the expenses with the revenues, and you want to think about, have we used up the value of an asset or used up a portion of the value of an asset? If so, we've got to record an expense. Just spending cash, and most of you will fall into that trap. You're going to see, hey, this company spent cash, that's an expense. Absolutely not. Do not be confused by that. Ask the question, what did the company get in exchange? Did they use up all that cash, or did they just get another asset instead of cash? So let's take a look at a couple quick examples here that'll just demonstrate that matching principle or the expense recognition principle. All right, so we're going to look at 3 weeks of activity. In week 1, we go out and buy supplies, enough supplies to make 100 lemonades for $40. So again, the supplies cost us $40, and we know we can make 100 cups of lemonade with that. So we're buying lemons, sugar, water, paper cups, straws, whatever other accoutrement go with it. Next, but we make no sales in week 1. Week 2, we sell 50 lemonades. And in week 3, we sell 25 lemonades. That's the only activity that we have. So my question is, what are our expenses for week 1? Are they $0, $40, $20, or $10? What do we think? $40. And that's a common trap, right? We look at week 1 and we see, hey, we spent $40. But again, what I want you to ask yourself is, what did we get in exchange? Did we use up all the value of those $40? Or did we just exchange cash for other assets that we will use and own and get a benefit from in the future? And of course, that is the answer. We've exchanged cash for another asset. So really we had no expenses in week 1. All we did was exchange cash for what we know to be inventory or supplies to make our lemonade, right? So we've exchanged one asset for another asset, but we haven't had expenses. We haven't used them up. In theory, we could go resell those supplies and get our $40 back. So we haven't had a supply. And again, I know most of you are thinking, well, those lemons are going to devalue and we can't sell them. Remember, we don't care about value or worth in accounting. We care about actual cost. So all we've done is taken $40 of cash and turned it into $40 of supplies. Make sense? Excellent. Common mistake, and that's, like I said, this is the most challenging concept in accounting. So get used to just not necessarily writing down an expense because we've spent cash. Ask yourself, what did we get in exchange? Do we now own something with a future value, or did we use up all the value of the cash we expended? In this case, we've gotten something in exchange. We got supplies for lemonade, so no expense just yet. In week 2, we sell 50 lemonades, so we use up half of those supplies that we bought in week 1. Half of the supplies. Remember, all the supplies cost us $40. We've used up half of them to make 50 lemonades. So what are our expenses for week 2?
$20.
Absolutely. $20 is the correct one. We haven't spent a dime, right? No cash has left our company, yet we've used up some assets. Once again, that's part of that expense recognition principle. When we use up some portion of the value of assets, we need to recognize an expense. And, of course, we would have gotten some revenue in week 2, right? Assuming we sell our lemonade for $1 a cup, we made $50 of revenue, and we've got $20 of expenses. We want to match the expenses with the revenues that they help generate. Excellent work. So week 3, we go out and sell 25 lemonades, which of course means we used 1/4 of the supplies that we bought in week 1. So what would our expenses be for week 3? $10, exactly. 1/4 of the $40 from week 1. 1/4 of those lemonade supplies, of course, that cost us $40, so the expenses would be $10. And of course, our revenues would be $25. Assuming we made and handed those lemonades over, we would have earned it. Excellent work. So this is what it would look like. In week 1, we had no revenue and no expenses, even though we spent $40. Week 2, we had $50 of revenue, $20 of expenses, so we had a gain, or what we know as net income, of $30. And week 3, we had $25 of revenue minus the $10 of expenses, so we had $15 of net income there. Excellent. So spend some time with the expense recognition principle. It's one of the tougher ones. Remember, the two main things that we are doing is matching the expenses with the revenues that they specifically help generate. And another way to think about it is, are we using up the value of an asset? If we've used up the value of an asset with no future value, then we also want to record an expense at that time, but not just because we spent cash. All right, so this is the accounting equation. We're going to go into some examples in the next video, and that'll be the last for the introduction to accounting.